So my name is Michael Lautru. I'm with Parvis Investments. I'm joined here with my good friend Robert Blake, also with Parvis, and a special mention to Ruth. Where's Ruth?
What's up?
There she is. She put a lot of effort into getting some interested people out here as well, because she's keen on becoming part of the Parvis team as well. So we said, hey, how about you come and join us? It'd be great, and we'll have a great time. So yes, thank you for coming out and joining us on this event. Oh, well, that's
And
right.
our marketing specialist.
I forgot. Sarah, our marketing specialist, she's very shy. She does everything behind a keyboard.
I'll
She's
just be
not
here in the
used-
corner.
So she'll be recording everything we say, so I have to be careful. Excellent. So thank you all for showing up. A little bit about Parvis before we get to the main events. Parvis has been around now for a couple of years. We're a publicly traded company. We're here to democratize getting people involved in the private equity space. In essence, that little unknown space that is available to people for investments. Most people understand stocks, bonds, mutual funds, going to the bank and saying, I need an RSP. And then basically the bank just puts you in whatever they feel is good for you or for them, and then continue moving forward. In our case, as advisors in the private wealth space, we help you find things that match your criteria and your profile as an investor. So different time frames, different returns, different risk profiles as well. And what we'd like to specialize in a lot is in the real estate space. However, we have been branching out into business services as well as some debt financing. Today we have some great opportunities for you available. We have some industrial services, along with some dental practices. If everyone has teeth, right? So, Lord knows dentists are very inexpensive. So definitely some money to be made there. Great real estate portfolio that's ongoing and growing with a very interesting exit. And then we have BrainFinance, a newcomer to our platform, who works in the micro lending space. So Parvis itself, we make it very easy for people to access all of the information you require in order to better familiarize yourself with the things that we bring to the platform and to your portfolios. And then after that, people like Robert and myself, we help you to fish out all the finer details and see if it's something that really does fit for you and your profile. So lots of past projects we've worked on. Again, lots of real estate, but Parvis with some nudging from a few specific individuals, not Robert and I. We've been helping to diversify that portfolio of assets for investors. So lots of opportunities, strategic growth, and every now and again I bring some special guests for some tax advice as well. I won't point him out today, but I will have him be a special guest on some of our future events. Platform is excellent to use, very easy. You can look at all of the different assets we have available for you for investments, read up on everything, and then in essence, you pick a handful, and then we walk you through if it's something that is actually suitable for your portfolio and how you can move forward with it. So different rates of return, depending on your risk profile and how long you're willing to let that money work for you. So returns range from anywhere from 5 to 27%. Typically on the low end, it's closer to 8 when you're getting involved with mortgages. And then if you're willing to let your money sit in some pretty interesting development projects, you can look at 27 or more over a course of a 5, 7, sometimes longer term. But if you're willing to let some patient money work for you, those patient dollars can really benefit you greatly over the long term. And so this is me. I've gotten a little bit grayer over the years. I have to get a new headshot for this. I still fit in that suit though. And I've been in the industry now for about 12 years. I've owned and sold a few businesses myself. Currently also run an interesting operation on the logistics side. Meanwhile, I also help investors to get better involved in the private market space and help them grow their own wealth while mitigating the tax man. So with that being said, this is the most expensive slide of the entire deck. This is our legal disclaimer. Nothing here is, we're not soliciting for sale. Nothing we say or we can't promise returns. However, with the experience that we've had, we can definitely guide you into some interesting cash flow projects as well as some overall long-term benefits for investors overall. So for our investors, we did talk about this briefly early on. They'll each have 15 to 20 minutes to present their offerings. So they've been practicing. And first up to bat will be our friend Michael from Newlook. And so he has two offerings, so he has 10 minutes each. Luckily, a lot of the slides are very identical in both. So I figured I'd ease us in gently with some dental. Everyone loves dentists.
What an intro.
I know. Hey,
Awesome.
all about the drilling, right?
Everybody does have teeth, that's true.
That is true.
Okay, hey everybody, how we doing?
Good.
That's what I like to hear.
Good.
So, very simply, we have two funds here in Newlook. And the first of which is the Dental Services Trust. Good news for everybody in here, it's not rocket science. We buy dental clinics. Our thesis at Newlook is essentially to buy recurring revenue businesses, defensive in nature, code mandated or regulated industries. And that goes for dental as well. Like, it's a heavy insurance-based industry. We're excited because it's heavy insurance-based and scalable. So, we have two offerings here. First is the equity piece, which is 6% annually as return of capital, paid out quarterly, with the opportunity to kind of grow with us. And then the other one is the 9% secured debenture, which is 9% annually paid out quarterly as well. So why are we excited about the dental industry? Because you hear the words dental and you're like, well, that's incredibly boring. And I say, you're right, but that's what we specialize in, and that's what we're good at. The reason we like dental so much is because when we took a look at different industries, we looked at optometry and vet clinics as well. And when you take a look at the Canadian market in the dental space, from a consolidation standpoint, Canada has a great opportunity here. Take a look at this right here. Canada is currently around 9% consolidated. When you look at the UK, 24%, and pushing 40% for the United States. There's still a long runway for growth in Canada. And when you consider the fact that Canada has 16,000 dental clinics, and we have 35 of them, there's a lot of room to expand and grow there. So we're really excited about this. When we got started, we started with 6 clinics back in 2018, and all of them were in Saskatchewan. So the nice thing that acts as a barrier to entry for us now is the fact that if you want to start a dental clinic, thank goodness, you need to be a dentist. And so we worked with Dr. Sam here when we bought our first 6 clinics from him back in 2018, and he's been with us since. And when we first bought them, you know, you have this idea. It's just a thesis at that point. 6 clinics is not many. So to de-risk the platform, sort of, if you will, our management put in $10 million of their own capital. And then since then, the platform's really expanded, and that's kind of since when we've expanded and added the equity offering as well. So this is a look of kind of where we're at right now. We're really shifting to acquisition mode. So, and like I said, initially it was just the debentures. Now that we have the equity piece in play, over the past year, we've really focused on kind of shifting the capital structure from, of course, when you introduce it, it's 100% debenture. Now we're sitting at about 55% equity, 45% debenture. So now we're really in acquisition mode. We're trying to expand the platform, grow it. So just to give you an idea and kind of line of sight into what we actually do, last year we were at 33 clinics, and then we, just in the last couple months, we acquired a new clinic and expanded our largest clinic in Toronto, and we added 9 operatories. So an operatory is simply a chair. So when you walk into a dental clinic, when you see a chair there, that's an operatory. So now we're at 35, and we've been growing quickly. So why Dental-Look? This is the platform that we actually own, that owns all of the 35 clinics. So when we look for dental clinics, we kind of have a fairly disciplined criteria, and rightfully so. When there's that many clinics in the marketplace, we can really be disciplined with what we look at. We're generally looking for over $1 million in production, so revenue, and 4 operatories, so like I said, the chairs or more, and room for growth. So we'll often look for where can we actually renovate or add more. Because for a dentist, that's not really their focus, right? You're focused on running a clinic. we're looking for high density or high value location. We put together what are called clusters. So there's value in owning a clinic, right? But there's even more when you own 5 or 6 in a small geographic area. You get things like the benefits of scale and shared expertise. Hygiene as a significant portion of the clinic revenue as well. So generally we focus on general dentistry, not so much the cosmetic side of things. Just because this is how we, with our business model, we're focused on the consistency. And what's the most consistent part of a dental clinic is the hygiene. So long-term leases are also important for us, when you want to make sure that when you're in a clinic, that's what you're going to be. It's not easy to go in. It's not like moving into a new apartment, right? You still have all this technical stuff in a clinic. And if you're a dentist, why would you want to sell to us? Why would you want to sell to a private equity firm? We're not a traditional private equity firm in the sense that many firms will come in, cut costs, cut people, treat them like numbers. We don't like to do that. We want to actually work with dentists, partner with them, and it should be a win-win for everybody. So at the end of the day, when you go to school to become a dentist, that's what you're trying to do, right? You're not trying to run a business necessarily. And so we'll come in and we'll try to make their lives as easy as possible. We'll take a lot of the back-end stuff away from them. But we'll also do things like mergers and acquisitions, so we'll add more to the clinic, and also renovations to that clinic. So our offerings, we have the equity piece, as I mentioned earlier. So we're looking at a 6%, 6 to 7% annual distribution for the equity piece, $10,000 minimum investment, registered account eligible. It's a 5-year investment term. And liquidity is as a function of the units of the fund. So essentially the way this works is as we continue to grow the platform, liquidity improves as that happens. And then this 15 to 20% net target return is what we've kind of built in. And so let's say we hold this for 5 to 6 years. This is based on, even if we don't grow the net asset value, our goal is to grow the platform to eventually sell it. And that's kind of where we're heading. And then on the venture side, you have 9%. Like I said, same kind of things apply. You get the $10,000 minimum investment. It's been around since November 2018. So believe it or not, we're pushing 8 years. I cannot believe 2018 was 8 years ago. Registered account eligible. Last blank. Jeez. I know, I just aged everybody. 5-year investment term, and then same thing with liquidity on a quarterly basis. I always like to show this slide because it shows the benefits of scale, right? When you improve, like our revenue has been growing every year. But as we build up the platform and scale it, so do the EBITDA margins. And just, I think that's an important thing to kind of present to show the benefits of scale. This is the team behind it all. This is the 6 original partners. They've been with us since inception. And for us, when we're a fund built on consistency in distribution, consistency in acquisitions, pretty much in everything we do, it's nice to know that it's been the same partners who have been here since inception. It's the same ones who have built this performance up in the past, and it's the same ones who will be here moving forward. Same thing goes with Dr. Sam here and Sean. These guys work together closely. Like I said, Dr. Sam has been here since the start with the 6 original clinics. And then Sean is the brains behind the operation at Newlook, kind of helping with the M&A process and building up the platform. And then this is the expensive slide, like Michael said.
The most expensive slide of the deck.
Shall I jump to industrial?
Yeah, you did good, man. That's 8 minutes. Wow.
Want to
You rocked that.
Is it just next?
Oh yeah, just keep. Yeah, it's the next one right after. Yeah.
Here we go.
Well, I have to say, everyone has teeth.
If you take anything away.
Yeah, I have a few investors here that have been in Newlook Dental for quite some time, and I'm sure they're pretty happy with it. Raise your hand if you're not. You don't have dental plans.
This is the original. So now we're on the 3rd rendition, as you can see, number 3, of the Newlook Industrial Infrastructure Services Fund. So when we started Newlook, this is all we had. It was the industrial platform. And now, when we originally started, it was just in Canada. And then the second one was Canada and the US. and closed-end fund. And now we're in the third rendition of it, which is an open-ended fund. And same kind of thesis, right? We're looking for businesses that are recurring revenue, code mandated, and defensive in nature. That's the kind of portfolio we're planning. And so the way I like to think of it is, how many of you are sports fans here?
Yeah.
I'm hoping for more.
Everyone's into real estate here.
That's my second favorite sport behind hockey. The way I like to think of it is, we like to play defense, but eventually we're also going to score some goals as well. That's kind of the way I like to think of our portfolios.
Like Senators.
I can't
When the
talk
Canadians come.
Go Canadians, go.
So like I said, we build boring portfolios, but to us, boring is a good thing, right? Boring is exciting, if you will. I know it sounds weird, but I like that. So we build predictable, steady cash flowing portfolios, recession resilient, essential services, government regulated, and long-term contracts. That's kind of like the semi-acronym, if you will. So what are we looking for in a business, right? We're typically looking to buy a majority stake in these businesses, anywhere from 50 to 70%. So again, traditional private equity will go in and they'll buy generally, we're not a traditional leverage buyout model where you go and you buy 100%. We're looking to partner with these business owners, right? That's an important part of our due diligence process. Some of these businesses have been around for, say, 15 to 20 years. But now it's, okay, how do we actually scale this? How do we take it to the next level? That's where we come in. So generally, we're looking at anything from $1 to $25 million in investment size. And again, I'll keep pushing this. We're looking for major recurring revenue. And that's a key component of how we structure our funds. We're located in Canada and the United States. Our portfolio, as you'll see in a second here. And then again, these businesses have generally been around for a while. And so knowing we have that track record to go off of is important for us as well. But where do we bring value? So generally, we'll come in first year, we'll kind of integrate this platform company, and we'll work on the back end things. So we might come in and put a new controller in place. We might have some CPAs in the room here. Put a new controller in place, we'll put new systems in place, and we'll work with the current founders to kind of see, how can we scale this? How can we grow this? What kind of targets can we set? And generally speaking, after that 1 year mark, that's when we kind of go into acquisition mode, and we'll focus on what we call these little tuck-in acquisitions. And so we'll start out with a platform company, and then from there we'll look to add on little acquisitions to kind of build into that company. Generally in the same industry and same geographic area. And so a big part of what we do, of course, is the M&A aspect of it, but there are so many other key components of what we do as well, particularly in that first year. So currently, as it stands today, we're at 5 platform companies, 12 if you include the add-ons, like I said. And I'll get to this in a second as well in the offering component. We're looking with the 8% distribution, kind of hit that mark every year. But for the last 3 years, we've been sitting at around 3% or 12% in our 3-year annualized. So we're right where we want to be in the top end of that range, and we look to continue that moving forward. That's kind of our goal. Now, the 8% is return of capital, paid out annually or annually paid out quarterly. And anything above that could come in the form of special distributions or NAV growth. That's kind of our target. And there's a 2.5% DRIP discount, so you can really take advantage of the opportunity to compound units. We own 5% in the fund, so it's nice to know when you invest in this. Management is investing alongside of you. Again, 5-year investment commitment and quarterly liquidity. Same thing goes with this. When you invest in here, the larger this platform gets, the more liquidity improves as it's a percentage of the units of the fund. This is the exciting slide, just to give you a sense of kind of where we invest and what the companies we own. So you have everything from plumbing in California to a fire platform all across Canada to wastewater treatment in Alabama. We're really all across Canada and the United States. Same thing as dental. We're really in acquisition mode now. We've had a couple successful exits in the last few years here. And so now as we shift focus to adding more to the platform, our goal is in the next few months to add a new platform company and continue to add on, particularly the fire platform here. We're looking currently at some new add-ons for the Canadian fire platform. Our pipeline at the moment is currently around 50 million, so we're really excited to see what's to come in 2026. Just to give you more kind of line of sight into, what do these companies do? What are they made up of? Living Water is a wastewater treatment platform in Alabama. And then Fireplus is a Canadian fire platform all across Canada. We're really excited about these, and just to give you a sense of what they actually do, the nice thing about what we invest in is the thesis is the same for all of them, but they're diversified across industries, right? One's in fire, one's in wastewater treatment. Totally different, and yet they still have that recurring revenue, code mandated. The work needs to be done, right? It doesn't matter what economic environment we're in. The work for these businesses have to get done, and that works as a benefit to us and our investors. So what is Newlook good at? What is our advantage? Well, you just saw it. Firstly, geographic exposure. In the industrial platform alone, you're looking at exposure in Canada and the US market, and that naturally plays into currency diversification. Because we have revenue and or net income coming in 2 different currencies, it acts as sort of a quasi-currency hedge. We're non-real estate. The companies we invest in are not tied to real estate, and so no matter what happens in the real estate market, these businesses are going to continue to operate as is. You saw it as well, industry diversification. I just explained that a little bit. It's nice to know if something happens or goes south in one of our platforms, it is totally unaffecting the rest of the platform. If something happens in the plumbing industry in Southern California, it's a totally different management team, totally different industry. That also goes into the non-public side of things. You don't have the same emotional reactions that you would get in public markets. It's nice to know that. And that all plays into the fact that we are uncorrelated not only to public markets, but also within the private market landscape and other asset classes within this. Now, how do we do this? It comes down to code mandated and long-term contracts. We don't use leverage like a traditional private equity firm might be known to do. And so, as we've seen over the last 5 years, we've seen different economic environments with different interest rate environments. And so we're unaffected by that, right? We're not buying these businesses with significant amounts of leverage. And so for that reason, we're agnostic to that. It's a pre-existing asset pool. Same thing. You're buying into a fund that you already know what you're buying into. You know the companies. We just showed you some of them. You know the companies that you're kind of investing in, and you have that line of sight. You skip the traditional J-curve that traditional private equity might have. And then we have smart money invested. Essentially what that is we have a few different institutional groups. We just like to mention this because it's nice to know that these groups are doing extensive due diligence, and just knowing you have that peace of mind that they're investing alongside of us. Now, we have many sectors of interest. This is just a few different examples to give you kind of an idea. The reality for us is we're always looking at different things, and if it fits that code mandated recurring revenue kind of thesis, then we'll look at it and we'll kind of see if it's a fit for us. So we're really excited about what's to come on the portfolio in the next year and beyond. Same thing here, same management team, but I think this is where I'll focus on here. It's nice to know when you invest in a fund, who's actually managing it. And this is the team that we have in place at Newlook. It's a mix of CPAs, a mix of CFA, charter holders, and really a mix of different backgrounds, and everybody's got a different skill set. And they have a good track record now of building this up. We're on the 3rd rendition, like I said. And so it's nice to put a face to, okay, who's actually, building these platforms up. And then some more of the exciting stuff. So I can now open the floor to questions.
Any questions? We got a few minutes.
I have a question.
Thank you.
So where do you guys draw the line between diversification and diversification?
Oh, yeah.
Because sometimes when you're too diversified, it's not good. Like it's diversification.
In terms of industry?
Yeah, industry like this fund, like all the you got some plumbing, you got some fire, you got some I don't know. So where do you draw the line?
Yeah, it's a good question. I'd say it's not too much of a concern, particularly just because of the holdings we have. Currently we have 5 platform companies. I think if we really upped that number and held like a significant number of companies, that might be more of a concern. But on top of that, because the thesis is the same, like you go commercial plumbing, for example, right? That's going to get done no matter what. The same thing can be said for wastewater treatment. And so if we go into, say, a recessionary environment, the same things that would affect one of the businesses affects the other.
So are you pretty much saying that because your thesis is recession resilient, things that have to be done, then whatever you pick fits, then it's not a diversification, it's a diversification?
That's the idea,
Okay,
yeah.
got it, thanks.
Everyone needs fire suppression,
It's true.
whether the building's empty or not. If they want new tenants again,
It has to be checked every month.
it has to be checked every month, right?
It's things you don't think about. It's always really interesting
Yeah.
Boring businesses. Lesson here is boring is good. It pays.
for us.
It pays.
And a big point is, if, you know, a lot of people in the room here are probably real estate investors with a lot of debt. No debt. So when you're building out portfolios, they slept like a baby all through those interest rate rises. But I'll tell you, a lot of real estate investors were not. So it's just again, diversification within your portfolio design, looking at these non-real estate opportunities.
Yeah.
Awesome. All right. Any other questions? Or, I mean, a question to that?
In terms of the entire thing, what deals do you guys typically walk away from?
Yeah, it's a good question. It depends on whether it's, you mean for both funds?
Yeah.
It depends, right? The nice thing about these industries is our teams see a ton of deals on both. Like there's a lot of opportunity. And so for that reason, they can be very disciplined in terms of like, what do we look at? In terms of specifics, dental would be easier to answer just because a lot of the business models are the same. Like I showed on the screen, there are specific things we'll look for in a dental clinic, be it the number of operatories it currently has, number of, location's a big thing. And then for both, you know what would be a deal breaker is who we're actually partnering with, right? Because it's traditional private equity, like I said, sometimes we'll fire current management, and eventually just take it over. Whereas we're partnering with them, so ultimately at the end of the day, you need to be partnering with somebody you're going to be able to have to work with, right? Our industrial team works with these business owners like all the time. And same thing with Dr. Sam and Sean, they work with our dental clinic owners all the time. And so you can imagine how painful it would be if you got into a deal with somebody you can't work with. So I'd say that's a massive deal breaker.
Five bad marriages, right?
Excellent. All right.
With the dental clinic, how many clinics do you guys plan on having? Is there a certain number? And when you get there, what's the plan after that?
That's a great question. So we're at 35. We love the industry, and so we're not tied to an outcome, but we're open to the idea of selling, say, if we get to double the size. I think that's kind of where we reevaluate. So we're at
So you're looking at another 8
70.
years if you do the same thing you've done the last.
Probably less,
No.
because we're looking to really expand now, like I said, acquisition mode, and so.
We have capital now.
Yeah.
More capital, more
No longer
recurring
6
income.
clinics.
Yeah. Not chasing investors as much anymore.
Well, I think
It helps.
So if someone's invested in a dental look and, 10 years down the line, you sell it. Obviously, if you acquire more clinics, you'll be valued at a different valuation. So what does the investor get? What do we get?
Whatever we sell at. So that theoretical return you saw, is based on an exit multiple that we have priced in conservatively. So let's say we buy a dental clinic at 6 times EBITDA. We, based on what we've seen in the market, you see things sell for like 10 to 14 times. We're priced at 9 times on an exit, like just to be conservative. And so if you're a debenture holder, of course, there is no upside. That's kind of the whole idea. But with the equity side, we'd share based on the profit sharing, whatever the total portfolio sells for.
Okay.
Yeah.
All right. Thank you, Michael. You'll be around after the rest of the event if you have other questions.
Yeah. I'd love to chat if you need it. Right?
Absolutely.
I'm not going to be the one doing that though.
So, all right. Thank you, sir.
Did we-
All right. Next we have.
Pardon me?
our newcomer, Mr. Rivet from BrainFinance. A very cool model. Something we've been looking for a little while, and finally came to be. So here, I'll give you the clicker.
So thank you. Thank you all. Thanks for having me. I'm Matthew. I'm CFO at BrainFinance. So throughout the presentation, I'll explain what we do, how our debenture works, the security structure, and why it's a great product. So before we start, I need to say that I'm a bit like Sarah, much more comfortable behind a computer than in front of people. So bear with me. And in case you did not notice yet, I'm a French-speaking guy. So apologies for a mistake I can make here and there.
No worries.
Don't worry,
So
it's all good.
about BrainFinance. So BrainFinance is a Canadian fintech focused on constructive credit for underserved customers. So we operate an end-to-end platform empowered by technology, machine learning, automated underwriting, servicing, and collections, proven at scale. We've been operating since 2016. The company has been created in 2014. So this isn't a new model, even though we constantly enhance it. We processed millions of applications, 3.4 million since the beginning of the company. And we did 1.6 billion in loans since the beginning, with a charge-off rate a bit below 4.5%. We're quite proud of those numbers. So the company is quite simple. We have the holding company where the management sits. Then we have BrainFinance, which is our technology company. And we have iCash, which is currently our operating company, where we do all of our operation, and Erna, which is our next product, and which I'll talk about a bit later. This is our leadership team, a mix of legal, accounting, compliance, AI, engineering. So yeah, quite a great team. So we operate on the Canadian market, and our customers are what we call non-prime or near-prime clients. So demand is need-based. People borrow to bridge cash flow gaps. So this shows the scale of consumer credit and how many customers fall outside prime underwriting boxes. So the market is about 250 billion and 10 million individual. This is our addressable market. So the takeaway, those customers really exist. We call them underserved by traditional credit. 50% of them live, more than 50% of them in fact live paycheck to paycheck, and 50% of them are $200 or less away from insolvency. Meaningful portion of Canadian, like I just said, don't have access to a regular credit solution. So we estimate about 4% of Canadian adults use short-term loans. We work in the same space as Money Mart and Cash Money. I don't know if you ever heard about iCash. We're online only, so you might have heard our radio ads that we did in Toronto last summer. If not, you probably saw those Money Mart shops all around. There's one around the corner on there. Right here. Yeah, and we're proud to say that since 2024, we passed in front of Cash Money, so we are probably the second biggest short-term lenders in Canada at the moment.
Nice. Very little overhead. You bring it back one slide?
Yeah.
So if you notice,
Yeah.
you look at the brick and mortar locations, that's expensive to operate.
That's expensive. That requires a lot of people. Like I said, we're solely online.
Yeah.
No
Fintech.
store, nothing. Yeah.
Future
fintech,
banking.
Exactly. We operate under the Consumer Protection Act, so we're quite heavily regulated. The way the product works, it's not an interest rate that we charge, it's a fee for $100 borrowed. So it's $14 per $100 that the customers borrow. And that's for a duration of around 7 days to 62 days. I would say our average short-term loans are 30 days.
But those are quick at math.
It's nice.
That's about, let's say, 14 times 12, if you do the math.
It's a high rate of return.
High rate of return. So iCash,
Or
like I
half
said,
charged off.
iCash, our main core product, so short-term credit delivered digitally with fast decisioning, servicing engine behind it, $100 minimum to $1,500 maximum. Maximum duration of 62 days, like I said, solely online. So we have the website, we have the iPhone app and Android app. So our main differentiators compared to our customers, except the fact that we're only online. So we're quite fast. So we win on speed, automation, customer experience, repayment flexibility. So in this category, operational execution matter as much as underwriting. So our process is fully automated, application is fast, decision time is less than 10 seconds once the customer fills the application. And if they are approved, they get the money in their bank account 2 minutes later. Yeah, it's quite fast.
Fantastic.
So in a nutshell, we have huge web traffic, a lot of contacts, lots of application, lots of employees. Like I said, about 350 for us. It's a lot, but compared to our competitors, not that much. We operate in 7 provinces. Huge customer satisfaction. So we have a huge operating machine behind that. Risk management, as you might expect, it's everything. So if we lend to bad customers, we lose money, and we don't want that. So our approach combines automated decisioning, monitoring, proven collection engine. So we've built a full loop: underwriting, servicing, collection, and we constantly update our model, improve our models. So our AI is not only buzzwords. That's what allows us to operate at scale with consistency, speed, and control. So even for customers with low credit score, we're able to target which one are good ones with high accuracy. So for example, that would be the expected delinquency as per Equifax. And the orange line is our own model, what we expect, and the gray line is what we achieve. So we are better than our model even. And that's what enables us to get that 4.5 charge-off rate that I just mentioned about at the beginning. And this is our default rate. The default rate means customers that don't pay at the end. It's not the same as the charge-off I just explained. I am showing that to explain that our default rate is constantly going down over time because we improve our model, we improve our collection, we improve everything that we do in fact. So on to the financial, the exciting stuff for a CFO at least. So a few tables here. Story that we have is consistent growth. I said that we started operation in 2016, and since 2019 we're constantly improving our numbers. So revenues in 2019, 14 million. We just closed 2025 at 70 million in revenues. That's and if you just look at those 2 years, it's a 30% growth in revenues. EBITDA went from 2 million back then to 15 million this year, which is again 30% growth this year, and our EBITDA margin went from 14% to 22%, so 14% at the beginning and 22% this year. Our net income, I don't have the table here, but net income was at break-even in 2019. We did 5.7 million this year, and our model is expecting 7.5 million in net income next year. So the key is the trend. We're now consistently profitable. By the way, we're audited since forever. We worked with EY in the past, and now we're working with M&P. BrainFinance is our tech company. So like I mentioned before, so we are huge on AI, automation. This is how we drive efficiency and consistency at scale. So we have a complete AI and data science team. We've been working with AI before it was trendy, so before even all those GPT and things like that. So maybe around 2019 we started to implement AI. Obviously it went much bigger or better over time with all the new things that went out last years. We do well. Our models they treat 90%, even more than that, credit decisioning. So there's no human behind the fact that do we provide credit to someone or not. For most of the application that we have 96% plus accuracy. We have 10,000 plus data point analysis on customers. So it's not like random that we provide loan or not to customers. We do a full analysis on them. We check their income. We check their spending habits, and all this to decide do we want to lend to them and how much do we want to lend to them. As you might expect, also we are quite huge on security. We cannot afford any breach at all for many reasons. Like we have a lot of personal information that has been trendy also recently, so we cannot afford a breach there. We cannot afford any downtime either because we do our business online. We need to be available
24/7.
24/7. So we're available more than 99.9% of the time. So I mentioned at the beginning, or now it's our next product, next credit card. We already have a deal with Visa. We're working quite close with EQ Bank also and a few other providers to launch that credit card. We're expecting to launch it this year. So it's the next logical step. So same customer base, same operating platform, and a broader product set. Yeah, that's. Oh yeah, I forgot to mention that. So we're going through a phase rollout, like control growth with discipline. So we don't want to invest a lot in that at the beginning. We're gonna accept only a few customers as we scale, as we grow, just to mitigate and control the risk. And we understand the short-term lending. We want to take the time to understand also the credit card, the way it works. So we're gonna scale slowly but surely in this way. Yeah. So this one, before getting into the debenture itself, here's our underlying foundation, defensible advantages. So we have a first-party data advantage. We're proprietary of all our data models and everything else. Regulated operating capability, end-to-end platform, like I said, and a product expansion flywheel from iCash to Earna. So this is what makes the cash flow engine durable. And then the investment itself. So why invest? It's an income-focused instrument with a predictable return, 12% fixed coupon, paid monthly. Secured possession through a deed of hypothec administered by a recognized trust company, Olympia Trust, if any of you know. And it's backed by our own expertise. The key terms and mechanics of the debenture, it's a Class C debenture, so we have A and B already. This is the third round. Class C debentures, $1,000 per debenture with a minimum investment of $10,000. 12% yearly, paid monthly, so cash distribution directly to investor. It's a 12-month term, renewable, so it can be canceled prior to the end by the investors, and we pay back at the end of the term.
Like your Spotify account.
I didn't know that Spotify can pay me back though.
Depends if you invest in another investment share. We'll talk about that one next week.
So use of proceed, scale our existing product, launch and scale the Earna credit card, strengthen our liquidity, and enhance the compliance and government as we grow. Investor protection, I mentioned that briefly. Security package, debentures are secured by a deed of hypothec from Olympia Trust. We have a strong track record, meaning that we have Class A and B debentures since 2021. We never missed any single interest payment, never missed any single debenture redemption.
And the revenue keeps growing.
Revenue keeps growing, exactly.
What about the market?
The market, that's a good question. It's growing. I would say that I think that we grew much more by stealing our customers, clients, than the market itself growing. The market is quite huge, 3 to 4 billion probably, so there's room for us to grow.
There is still competition to steal.
There's still competition to steal. We're much faster, we're much better than those guys. We don't charge hidden fees like they charge
Any new
interest.
competition coming soon?
There is. The market got much more regulated at the beginning of 2025. So the $14 that I explained went from 15 to 14 on January 1st. Since we don't have any brick and mortar and our fixed costs are low, we were able to take the cut. We think that some companies like us couldn't take it, so that might be why some customer came to us. And also, we were looking to launch installment loan. They were regulated from 60% interest to 35% at the beginning of the year, so we decided not to go there. And we also think that some of our customers, they just closed, and that makes some more customers available for us.
Thank you.
So that's it for this one. Operational strength and risk control. So we focus on pipe control, discipline, credit risk control at scale, regulated oversight with established governance, active liquidity management with senior lender reporting covenant. I did not mention this one. We have a senior lender also. So we use the senior lender to fund majority of our loans. We are under constant review with them. We have to comply with covenants and checks and audits and things like that. And so that's kind of the first line of defense. We have automated fraud and KYC for the oncoming customers. And like I said, we have a phased launch of the credit card control rollout, measure expansion coming this summer. So yeah, that's it for the presentation. Thanks for having me. To stay in the trend, I have also our own.
It's a very expensive slide. The legal. So that's it. Happy to answer any question. Yes.
So are you, do you take reg funds?
Take what?
Registered funds?
No, we don't yet. We explored the opportunity. We might consider it at some point. There was some block-ins for us. We just started with. Well, we have some debentures, but we have about 30 investors now. We are looking to expand. I don't know if you're aware of all those rules for the registered fund, but we need 150 investors. So we don't want to say we're going to offer register, not reach the 150, and then make all people mad at the end of the year.
So why do you need to go through Olympia Trust? Can someone just directly invest, or is that for easier to see where your stuff is?
Someone can directly invest. They don't need to have an account at Olympia Trust. We have them for a few reasons, mainly because of that deed of hypothec. And the second one, they're the one that are paying the customers. So they're calculating the interest that we do each month. We send them the check, and then they send them the money to customers. They also produce all the tax slip for us, which is very convenient also.
So it's kind of like just to reduce somebody having to do that.
Yeah. Yeah. And then if we forgot someone, we can blame them.
Yeah. Got it.
So, and you're in Montreal? Or?
Our head office is in Griffintown.
So is the minimum 10,000, is that what I read there?
Yeah, minimum 10,000.
And it pays 12%?
12%.
And you guys charge 14?
$14.
$14 per hundred.
$14 per
Okay,
100.
100 was 14%.
No, it's $14 per 100 with the average duration of 30 days.
That's okay.
So
14%.
But if it goes beyond for 30 days, do you charge additional for
No.
No.
So it's from
They have 62 days.
62 days, okay.
7 to 62 days. Average is 30 days, more or less. So average APR that we have is 168.
And that's paid monthly, 12% paid monthly?
Yes, paid monthly.
So,
So what are the typical reasons people are using these loans? What are some real life examples?
Real life example, we spoke about dentist earlier, so people that need to. That's true, because we ask why do you need loans, so dentist repairs, car repairs, often back to school, people need to buy month-end bills, month-end rent, like people that they can, and those people, remember, they don't have access to a credit margin, they don't have access to credit card or customers, so we are their only hope.
so how much money does the your management team and the founder have? And also, are you getting eyeballs to your website?
Management team, so we have only one majority owners, that's a lady, she owns 99 point something% of the company.
But how much money does she have invested?
So I would say more or less $1 million. They're not putting any dividend now. Money is always reinvested in the company. Like I said, we are cash flow net income positive since 2019. Our, I would say, retained earnings, because we had losses at the beginning, so we went retained earning positive back in beginning of 2024. Now we have, I would say, 11-12 million in retained earnings. So they are all reinvesting in the business to grow the credit card program. And we used to have about 20 investors also. So at the beginning, she was majority by 70% and 30% was minority investors. We all bought them back throughout the year. Now there's only one left, so that's why the 99 and 1%.
And what are you doing to get eyeballs to your website?
Mostly Google Ads, TikTok, YouTube.
People like Sarah buying a keyword.
Yeah, we have a marketing team, 4 or 5 people, maybe a bit more than that. We spend around, well, not around, we spend $400,000 a month in Google Ads, another $100,000 here and there. So 5.6 million, between 5 and 6 million on marketing.
How much is this
each year.
percentage of the revenue?
So 70 million in revenues, 5, 6.
Okay, understand.
So that's about 10, 11%.
12%.
It's good having the CFO here, right?
Yeah, he knows all the numbers.
Yes.
I don't know how much of your dollars in circulation in comparison to what's held in cash, just for this purposes.
Good question. We have about 10 million in cash and we have about 50 million in circulation, more or less. Yeah.
Brain and data location is in Canada or in Quebec?
Yes, in Canada we work with Google a lot, so it's all in cloud in Google.
Good question.
Clarification.
Google Cloud, but Canada or?
Yeah,
Canadian
Canada.
data center.
Canada, yes.
Canadian data center.
Yeah,
So your return, the 12% return, is that annual or monthly?
it's annual.
Paid,
then
annual
the-
paid
But
monthly.
paid money.
Yeah,
Or paid
paid
monthly, but the
1% a month.
just to sort of reiterate his question, the 14% though,
That we charge to customer.
is averaged monthly.
Yeah, it's hard to picture it that way, but yes. Yeah.
And when Olympia Trust act as an administrator for you guys, a customer that, I mean, sort of like an administrative, maybe not the official title, customers that have an Olympia account in registered funds will have to withdraw their registered funds to invest with you guys.
Yes.
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 Or they can open a non-reg.
You can open a non-registered
Yeah.
Olympia.
Yes.
When you say registry, you put TFSA and RSP, not just RSP, right? Both of them.
Both of them, yes.
So far excluded.
They're not an NFT. That's,
Okay.
Yeah.
that's
Yeah, they're not an NFT yet, so.
Yeah.
We can get 150 unique investors.
Yeah.
That's
see-
open, it's
I
open
see
to
40
register.
right here.
I see 40, we only need another 90.
Yeah.
3 events and we're done.
40 more or less.
Yeah,
so-
give me one
3
million,
events,
I'll
Mario,
take
and we're done.
Yeah.
What's your
That's it.
niche market for the credit card? I know that, like Capital One is for people trying to grow their credit, Amex is for the people that,
Yeah.
just can spend money. What's your niche market?
That's the same customer as we have now. So we're targeting the people that don't have access to credit card at the moment. So that's what we're looking for. So those people, obviously, we will have higher fees and interest than other because we're taking risk. We know that we're gonna have those charge-off and write-off. So obviously those people, they will build their credit with us, and we don't expect them to stay with us forever. So we're targeting the people that don't have access to credit card, newcomers maybe in Canada, those kind of people. Limits are going to be very low at the beginning, so $500 to $1,000 limit. Those limits will, well, there's a huge deck on the credit card itself. The limit will increase over time, and that will help people to build their credit and to move to a more typical standard credit card.
Yeah, and what's the security on the credit card, like for anybody that's, for you guys, like the investors, but how are they protected?
Yeah, how are you underwriting that?
It's the same as the iCash product that we have now. So we have, like I said, 10,000 analysis data points. We have our models that are built. We're quite good at doing this. So our, like I said, our charge-off rate, it's 4.5% of the money that we originate, that we lend to customers. Obviously, that's a huge amount. I say we did 70 million in revenues, and our loan losses is about 30% of the revenue. So our biggest expense on the income statement is the loan loss. So let's say about 20 million this year. So we did 70 million revenues, 20 million loan losses, when we have 50 million net left for our cost and returns and all of this.
So if you're investing, then 12% is guaranteed, even though you guys lose money?
I cannot say it's guaranteed. We are proud to say that we never missed any payment, and we want to do all of those payments. The investment is secured by an hypothec by Olympia Trust. Secured doesn't necessarily mean guaranteed. So it's not, I can't say it's guaranteed.
Because if you lose 30% of 14%, you've just lost 4%. So now
Yes.
you're down to like 10. And
So-
if you owe me 12,
It's, well,
Yeah, his
So
10%
your
monthly
12 is
is
annual.
yeah, exactly.
Your 12% is annual. It's
well, no, but if
14
they've
is
lost that
monthly.
in revenue throughout the
So
whole
they're bringing in
year,
180%, and then lose 30, and they're still at 150.
Yeah, so that's exactly it. So we
There's a lot of margin.
170% per year, and we lost, so let's say we do net about 9.5% monthly. So let's say 10% monthly, we do 120% each year, and then we pay 12. So, yeah.
so is the credit card a separate investment, or is that all together?
It's all together.
And how do you spend the rest of the money for development, for future development?
Yeah, development, continue to grow the business, exactly. Development, yeah.
You said that the iCash is backed by a mortgage. You said by an hypothec.
Not iCash, but the debenture itself.
The debenture is backed by an hypothec.
Yeah.
Who's the owner of that security?
Exactly, there's a security registered, hypothecary, guaranteed, registered by notary through Olympia Trust.
Correct me if I'm wrong. You mentioned that you have a huge data which is used by AI for this decision-making process, and that's your main accomplishment. But considering the fact that in Canada there is no open banking and the main information for you to make a decision is basically the bank transaction and
Yes.
credit card transactions, how do you collect this information to feed the module so they can make the
So
decision?
there's third-party companies, mainly Plate and Flinks.
Oh, you play it? Okay.
Yeah, so we work with them.
And
we
that's
get-
mandatory for each customer to connect?
Yes, it is.
Okay, understand.
Makes sense. Do you, so our neighbors there, do you anticipate that there could be that policy where their leader had put in place, I don't know if it's enforced, where credit card rates are supposed to go from 20-something to 10% max?
That could happen. In fact, it was regulated from 60% to 35% at the beginning of 2025, so we needed to revisit all of our models. The main revenues for us on the credit card won't be the interest. So we'll charge annual fees, like many credit cards on the market now. So that's going to be our main source of revenue, those annual fees. And we're going to have a bunch of fees here and there, like a few dollars here to, they can borrow money from the credit card, transfer money to their bank account, things like that. There are going to be fees for a bunch of things like that. How do you say, I forget the term, but those Visa company, they charge like 2% or to the merchants. There's a portion that goes back to us. Interchange, exactly. So those, so the interest portion is not our main revenues on the credit card model.
Very good.
Which credit bureau are you guys using?
Which
credit bureau is the client going to be registered for when you give it credit cards?
we work, if I understand the question, we work with Equifax a lot. Is that what you mean, credit bureau? Yeah. So Equifax, that's our main. We also have TransUnion, but we use mainly Equifax. We're connected to them. We're probably gonna connect the iCash short-term loans to Equifax, which is not yet. And we have a bunch of services with Equifax also that we use. So they are our partners since many, many years.
The other question is, I'm the client that wants to get that card or loan. What are the information that I'm providing for you to meet those data points that you guys are?
Mainly, there's a form on the website that would be bank information. Like we said, you need to connect through Flinks and Fled. Flinks and Fled. And then you put your cell phone, your email address, where do you work, where do you live. That's
Firstborn child.
That's basically it. And then we launch our AI everywhere, and our models, and they took, like, our lives is on the internet now. So
Do you disqualify candidates for gambling?
Oh, sorry.
So when the client applies through the Flex, that's when the AI analyzes the actual profile of the client.
Yeah, so we look at the data for the past few months, spending habits, revenues. We accept people that are unemployed, but they have like government revenues. So we accept those people also, as long as they have steady income. And no, we don't accept people that have gambling habits.
So Mr. Eva will be here all night for more questions. But thank you so much, sir. I knew it was going to be an interesting conversation. And so we'll just move on with the rest. We have one more rock star presenting today. Where's Jacobs? Oh, he heard me. Go ahead.
We have no standards. But I tell my wife always, the secret to happiness, very, very low expectations and mediocre results. So let's surprise you with mediocre results.
So boring investments.
Another boring.
Yeah. I know it's boring. I couldn't do the sophisticated stuff. I'm not smart. Where do I press to, like, just the arrows?
Yeah, just the arrows.
Told you I'm not smart. Let's start from the beginning, because I think that this is the simple stuff. I'll share a bit my story, so you'll know who I am. I'll talk to a couple of you guys out there. But my name is Jacob. I was born and raised in Israel. I moved to this country when I was 22. Finished my service in the army, and I had a girlfriend at the time that moved here with her parents, and told me she's not coming back. So I did the next most logical thing. I told her, sure, I'll pack my bag and I'll come. And that was it. I wasn't sure if she's too happy about it, but I told her anyway. And basically, she's now the mother of my kids. So as of today, it worked out. As of today, it worked out. This should be to her, not to me. So I come here at 22 and didn't really graduate in high school, realized it wasn't really my thing. Not that I couldn't, but it just wasn't my interest. And I come here and I'm 22 and I'm broke, and we're both broke. And, you know, like classic immigrant story, sometimes you don't have a lot of money to eat, you don't eat as much, you like kind of go through that.
You came to iCash probably?
I knew at the time. Nobody was willing to give me credit at the time. So definitely needed that. But, you know, kind of the one thing that is clear when you come to Canada is that the baseline of working hard here is a competitive advantage. Because anywhere else in the world, whether you come from the US, Africa, India, China, Israel, where I came from, you have to work extremely hard just to stay afloat, and then you need to get lucky, and you need to be smart, and you need to know the right people. And I think for me, it was very clear. I lived in a shitty old apartment building in a nice part of town in Toronto. But we had a park next to our house, and at 5 p.m. I'd see the park full, and at 10 a.m. I'd see the park full, and I was like, nobody works here. This is easy. This is easy. All you got to do is work hard. And out of these, I figured like real estate is my path. Like, maybe the Jewish part of me, like 50% of that industry is practically Jews, the other 50% Italians. I figured I'll play to my angle. I'll reach out to a bunch of Jews and Israelis, and I'll try to get in. And I basically said, pay me nothing, I'll make you coffee, I'll do whatever you want, teach me the business. Out of many that I tried, one picked up the phone and said, sure. Through him, I met a bunch of people, and I started basically doing what I know today is investment banking, but I didn't really understand what I was doing. I was just trying to put a bunch of deals together. And out of my shitty living room, in a few years' time, making it short for you, I raised about $300 to $400 million. Direct equity, complex corporate debentures. I started understanding what I was doing. At the beginning, I was literally putting people together, and at the end, I really knew what I was doing. The winter break of 2019, I read a book that changed my life called What It Takes by Steve Schwarzman, and he talks about how he left investment banking at Lehman. He started this company called Blackstone.
Whoa.
And he figured he started by having an investment bank so he could talk and make money without taking risk while he built up his private equity practice. He said, he's smart, I'm going to build the next Blackstone. That's the ambition. And in 2020, January 2020, come and we start King Capital Partners as a real estate investment bank. March 2020 comes, and what people are desperate for? Money. So we come in, and out of the gate, in 2 years, I raised, structured, whatever you want to call it, about $2 billion of equity, debt, funds, anything in between. And I think at the essence of what I was doing, when you think about it really, you match the right capital source with the right opportunity with certain expectations of risk-adjusted return. That's really what you're doing as an investment banker. As an asset manager, you're not doing something too dissimilar. So when you think about the biggest asset managers in the world, whether it's Brookfield, BlackRock, Blackstone, and all the big names, they're identifying the overarching trend of whatever they're investing in. Private equity, technology, whatever that may be, real estate, where there's shortage, where there's need, and they say, okay, let's deploy a bunch of capital. But they don't come in and start the business themselves. They buy an operator, they partner with an operator in that field, and they back the trend. That's what they do. They manage large sums of money without operating in the weeds. They have the overarching best practices that they've developed over time, and they're betting on the trend. Because the trend, the truth is, the trend is far more important than the underlying operating business, whatever that may be. In our world, real estate, you could be the best developer in, for example, Toronto today, the best developer in the world, and you'd still not be able to build a building because the trend is against. And you could have been the shittiest developer in the world in Toronto for the past 20 years, and you'd still make a lot of money because the trend was with you. So the trend was far more important. And in 2022, after we've had a very successful run, we made the transition to the asset management business, and I started a development fund with a public company out of Israel. My world, obviously, as you can understand, is more institutional than the investment advisors and the retail. I'll tell you about my partner more that has more experience in that world. But when I started that thing, I had a thesis that if in 2022 I buy pieces of land when the rates were starting to climb, in a market like Toronto that for sure has a shortage of housing, by 2025, when we finish zoning it, we would be the kings. Thank God, I'm luckier than I am smart. Because a year later, I got bought out by my partner. But the lesson I got from it is still very meaningful. If you look at all the most successful business people and investors, they've had an terrible experience of having a massive loss. Thank God I avoided that, but the lesson remained. The first question I've asked myself consistently when we started investing in new theses and new platforms, if I'm wrong, how does my downside look? What people fail to understand is when they look at high risk, high returns, it's not a linear graph where if you take high risk, for sure you make high returns. If you take high risk, there's a greater chance you'll lose all your money. That's really what it is. So my question coming from the land world in 23, where can I put my money in a place that makes sense? And even if I'm wrong about all my assumptions, I'll still be able to make decent money. And don't forget, 23, at the end of 23, COVID is still lingering around, rates are at the peak, nobody's even thinking of reducing rates. And I stumbled upon a friend of mine that I knew for years at that time, that was a real estate developer that couldn't make the math work and ground up, said, hey, we got this building that fell out of contract, the broker called me, what do you think about that? It's an apartment building in Montreal. We ended up tying it up. We can kind of start, but basically, as I was diving into the thesis and try to understand, this is basically what I found, and this is recent data, but like going back a couple more years, it was even more obvious. Montreal is by far the most affordable market in Canada, and truthfully, it's a top 10 city in North America. It's by far, like by a long margin, the most affordable city. Like we lease our one bedrooms for like $1,200, $1,300 a month. The renovated ones. The unrenovated ones, we have people on our rent roll that are paying us $600 or $800 a month. The turnover in Montreal is healthy because there's a lot, I call them, shitty old apartment buildings. There's tons of them. In Toronto, you can't afford to move, so people don't move. If you've leased a unit in Toronto 8 years ago, you're not going anywhere. Because anywhere you move would cost you almost double your rent. Because people are stuck. But in Montreal, everything is so affordable, you can always move to the next one. We literally had people on our first acquisition that we bought within the REIT, they were paying us $600 for a one bedroom, and they didn't like the noise because we were turning over so much of the building that we offer them 1 month free rent, and just if you want to go, you can leave. And they said, okay, thank you. Like, okay. This is great. And we looked at the first building, and I was looking at it in 23. 5.25 cap rate yield with about, at that time, CMHC MLI Select was approximately the 4.4. For those of you who are not familiar with CMHC programs, the government basically gives you a bunch of incentives based on the work you do for old apartment buildings, because there is no new apartment buildings by and large that can serve the people. So if you build energy efficiencies into the buildings, if you put affordability, if you give accessibility, you get certain points and you get better rates and better terms. We literally borrowed 95% from the government at a cost of 4.4 fixed at the time where you couldn't get a mortgage for your house for less than 6.5, right? But we bought it with a positive spread between your yield to your borrowing cost. So I knew, even if I'm wrong at anything, as of today, I'm making good money. Just holding the property, making good money. But if we were successful in what we were planning, which is turning over the units, we bought this building with an average rent of about $950 a month. Fast forward to today, like it's a year and a half later after we closed, we're under contract to sell this building for the price we projected to sell the building at year 5. And if the transaction go through, we would more than double our money for ourselves and our investors. We're one of our largest investors in everything that we do, which is another lesson that we've learned over the years. And it didn't happen yet. We haven't closed. I said when the money's in the bank, this is when you celebrate. But we've increased the NOI in the building in the range of like 15 to 20% within the first year. Basically, within the first 6 months, we've completed most of the business plan that we had for the building for far less of the cost we projected, and I felt this is money on the table. Montreal is just money on the table. The operator that we're buying from, whether they're big public companies, institutions, or individuals and privates, are what I call 15, 20 years behind Toronto. The level of execution and operations to serve the tenants, it's a business to customers business at the end of the day, is just not there. Because it's so easy, for so long people just made a lot of money just doing nothing, that it didn't matter, that if you serve the people properly, and don't forget, like not long ago I was one of those customers, if we serve them right, if we clean the property up, if we treat them well, they'll pay us more. And if they don't want to pay more, they have so many other alternatives, they naturally turn. So I liked a lot about Montreal, and we started basically our thesis. We bought this building as a separate limited partnership, and then we said, okay, let's make it big. At that point of time, I met David Hennig, which was one of the founding executives at Starlight Investments, which you may have heard of. They are the largest landlords. He joined them when they had $0 under management, and they grew to the largest landlord in Canada with 30 billion of AUM global. He was there basically from day one, from the start, from the inception of that, and he saw the same thing. At the time when they started, when they produced the best returns for their investors, there were a few things that were happening. The spreads between the borrowing cost to the stabilized yield after they finished the value add was 200, 300, or I guess, sorry, 2 to 3%, call it, give or take. It was a time where the institutional money was out of the game because pension funds didn't like to own at the time apartments. They didn't want to get involved with their pensioners. And retail money through the public REITs or private REITs didn't really invest in that asset class. So it was wide open for privates. And literally they bought up the country. So that's kind of what we were planning to do, and we came together and we formed a private REIT because we figured closed-ended funds, you're basically making a bet that by 5 years your market is going to be perfect and everything is going to be great. And if it's not, it's a very uncomfortable conversation with your investors saying, oh, remember I promised you your money back in 5 years? I need another 3. Right? That's it. That's a real thing. If you raise money in 2018 and try to sell in 2022, you can't. And you're kicking the ball down the line. There's big development funds in Toronto that I know that are in their 15th year on a 7-year fund because they can't meet the market. So we said open-ended structure, and we'll go into basically what we're talking about. So this is the thesis. Clear, cheap, affordable, very instantaneous path for growth through operations, good spreads between your cost of borrowing to your ability to acquire. This is easy. The structure. We put the twist on a couple of things. My background, being as an investment banker, matching the capital with the opportunity in the operating partner. Very early on, I figured I'm not going to be the guy who's going to be the best guy managing a construction team on executing a value add. But I got the thesis right, and I have the relationship, and I know how to structure it. So I basically created the solution for most operators in that market. When the big players are coming to Montreal, which is a different market to operate in than Toronto, they would have what I call, a lot of them are my friends, but an analyst that sits in Toronto that is responsible for about $1 billion, he barely see the properties maybe once a year, and there would be a third-party, unrelated property manager that is taking care of the properties. So think about it. A person that is not related to your success is managing billions of dollars on your behalf and your investors' behalf. What I found works the best is a line item. So what I've done is basically a hybrid. From the outside looking in, it looks like we're vertically integrated. From the inside, it's not really. They're completely separate. We have the REIT up here, and we have a thesis, and we find the thesis, and we find the local operator that has decades of experience in exactly doing what we want to do, and we effectively partner. So when Blackstone wanted to come to Canada and say, we want to buy industrial, they didn't start Blackstone Industrial Inc. They bought pure industrial from the market, and they manage it. I have a good friend of mine who was the first employee in Canada of Blackstone. They have in the office about 13 people today. 7 of them are salespeople, 6 of them running the operation. They own 2 businesses in Canada in real estate. One pure industrial, one Tricon that they took private a few years back. They manage between them 10 billion of assets, probably 2 senior guys managing the business. They manage 10 billions of assets with effectively 2 senior people. That's what it is. That's where it is. Every time you go into a big developer's office and you look at all the people, the first question you want to ask yourself is who pays for it? And the answer is always the investors. We like the lean, so we can charge less and we can be aligned, we can invest as much, and that's really what we've built. We have strong local boots on ground, owner principal that is our partner, that invests money into every deal that we're doing. He's signing all the loans with us. He's not making money on the property management. It's literally a cost plus 1% just to have a buffer. And if we do it well, we all make shitload of money. And if we lose money, we all lose money together. Alignment is the strongest force in investments and always have. So that's what we built on the structure side. From an operation side, we have boots on ground that gives us an edge. It costs us far less to renovate units because of it. So in the big shops, when we start going to the market and trying to assess how much it would cost us to renovate a unit, I would get numbers between $15,000 to $20,000 a door in Montreal. Does somebody want to take a guess how much we're turning units from scratch? Like flooring, kitchens, pot lights, showers. Anybody want to take a guess?
5 to 8.
How much? 10?
5 to 8.
8?
Yeah.
We're approximately $6,500 on the first building. The second building will be probably $5,000.
Not just for the materials.
When you have an operating partner
But
that
they don't
negotiated bulk. We negotiated bulk. We have the ability to leverage our economy of scale and the operator experience. When you build a building, it's far more complicated.
Sounds too good to be true.
I don't know. I don't know. It's just cheap. It sounds cheap, but it is. Montreal is cheap. Montreal is cheap.
Not like Ontario then.
No, in Ontario it would cost. If we were to do the same thing in Ontario, it would probably cost us, if we're efficient, $30,000. If we're efficient, it costs most people like $35,000 to $40,000.
Wow.
Massive difference. And the truth is, we don't get, in Toronto, when you turn over an old unit, you get a pop of $1,000 a month. It's a big pop. In Montreal, we would get, on average, 300 to 400, but we have a much higher turn. We turn, on average, in our buildings, about 20% of the buildings in the first couple of years until we stabilize them. So we come in, we clean them up, and we can talk about a couple of examples if you want, but this is really what it is. The second part that I've learned from what I call the master of multifamily in Canada, the guy who founded Starlight, relative to other multifamily investors that exist in the country, whether in the public market or the private market, he was always a massive investor in his own vehicles. Always. That's how he became a billionaire. He didn't become a billionaire because he made fees. He didn't become a millionaire because he had some carried interest at the back end if and when. He was a big investor plus carried interest. He compounded his money in a meaningful way. We're going to grow this vehicle to about $1 billion NAV in the next 3 or 5 years. We're probably going to be anywhere in the 10 to 20%. We like to say 10% because this is where we're at right now. But we're always going to be a very large investors because that's how we're going to make our money. If I want to make a lot of money, I put a lot of money and I need to keep rolling it in. Otherwise, it's not the game I'm playing. And you can look around and you can see a lot of other funds or whatever. You should ask the managers how much they put in. You should ask. Like, it's a good question. In most cases, it would be 3% to 5% at best. And in most cases, their fees are going to be materially higher. The things that we've done on the structuring side of the fund, we took an open-ended structure, but we behaved like a private equity. And what I mean by that is we took our fees that typically on an open-ended structure marked by NAV. So you come to Mr. Investor, we appraised our properties and therefore your NAV have gone up by 20%. So therefore, we're going to increase our fees on an annual basis. And by the way, we're taking our carried interest before you got $1 out of it. So we've basically said this is not alignment and it's completely irrelevant. We make money at the back end when we sell. If we did well, we get our carried interest, like a private equity deal works, that's where we make our money. And if our property goes up or value or down in value during the time where we own the asset, it's completely irrelevant to the fees. So we have 0% asset management fees for the first 2 years until we stabilize the properties. We stabilize them faster. But we said during that time, because we're big investors, we want as much cash flow. So the more cash flow we can make, the better it is for us because we own a lot of it. So it's good for me. I need the dividend. I want dividends. So 0% for the first 3 years until we stabilize the properties, and then we fix it at 0.2% going forward because we want to get as much growth from the cash flow as possible, and we don't need the overhead. It's just useless. So that's how it works. It's obviously we're eligible. We've done all these things. My partner was the chief legal officer, and let's talk about the team a bit because really what it is the thesis, the structure, and the team. And I'd say out of all three, the thesis probably play the biggest role because you can have a shitty team, but if you're in the right thesis, you still make money. But I'd say the second thing would be the team. And as you can see, I'm by far the best looking here, but by far the least smart. So, Mr. Hennig here was chief legal officer of Starlight, literally structured anything you can imagine under the sun. All the public listed vehicles, closed-ended vehicles that are listed, unlisted, trust, public, anything under the sun, they've done, including big institutions. They had 8 or 10 retail funds that they structured to raise money for. He's seen anything under the sun of the multifamily, knows the playbook by heart, and that was, I guess there's no real shortage of life or shortcuts in life for success, but if there is one, you gotta find the people that have walked the path you want to walk on, and he seems to be the best guy. Mr. Vered here, I want to say his family's 40, 50 years in the business. Come from the tech world, joined the family business about 2 decades after he ran a big tech company. And then he started developing condos in Montreal, then rentals, partnered with some very big names, and when he couldn't make it work, we ended up partnering and buying income producing. Very efficient, very methodical operator, very, very good, like really good at what he does. He currently owns and manages a Class A apartment building in Montreal, like a brand new with all the bells and whistles. Very competitive market, as I'm assuming you have in Ottawa as well. Like the top end of the market is very competitive because of all the new supply. He manages to have the best occupancy rates in Montreal, highest rental rates, and the best Google rating for all the downtown core. Figured if you can compete there, you can for sure do what we're doing, and that's kind of how we started. We obviously, our institutional background, that's kind of how we structure things. So we take the best lawyers we can find or know because we've done a lot with them. We take the best accountants, we take the best lenders, we take the best of everything. We've actually structured the property management ourselves. This is a vertically owned and run by Mr. Vered. We brought in Josh Varghese as our first board member. We have an independent board member. We're structuring like an institution even though we're just getting started. And just kind of to summarize it, we're now today, by the end of the next quarter, by the end of this quarter, we'll be at about 200 million of assets. We bought our first property in July. Within the fund, we bought the first asset in Montreal about 1.5 years ago that we're about to exit from. We're seeing, I don't know if every deal we're going to double our money in 2 years, but what I will say is this: we're seeing the same patterns exactly. We're way ahead of the business plan in a very short period of time. In the first building we bought in July, we just did the Q3 report, which I'm happy to share with you if you guys would like to see it. We basically completed 73% of our business plan at about 70% below the cost that we projected in about a quarter. We did the first quarter of basically cleaning up the property, renovating as many units as possible, and then we're about to complete the lease up, I think, by the end of next month. So it's going to be fully stabilized to a greater NOI within, call it 2 and change quarters. We projected, we have a refi coming up because we bought it with an existing debt. That we're probably going to refi double the amount of equity we projected to refi when we bought the property. The second property, which is far bigger than we bought, we plan for renovating about 70 units out of the 400 plus. By the end of this quarter, we'll renovate about 100 units. in basically quarter and a change. And will stabilize to a far greater NOIs. The way it seems, it will be fully stabilized somewhere around August or September. So this is kind of what we're doing. I think we got the thesis right. I think we got the structure right, and I think we got the right team to do it. And that's what we're doing. And we're raising about 100 million by the end of next quarter. That's the goal for the initial raise. It's an open-ended vehicle, so we're going to raise probably 300 to 400 million and then start deploying it over the next couple of years. The goal for us is to be at about $1 billion of assets by the end of this year. So far, we've succeeded to get about 50 out of 100 from committed to closed capital at a time where people are having a hard time to raise a dollar. I think that speaks volume, not about the fact that we're so smart, but I think we got the right thesis and the right assets that we invested in. That's kind of what it is. Make sense?
Yes.
Questions? If you want.
Average exit time for the properties, what is it?
Sorry?
The exit time for the property.
We underwrite every deal that we do for about 5 years.
5 years.
So if we can exit earlier, we'll do it. If in 5 year time, I'm telling you, look, I refied most of the equity back, but I don't think it's the right time for us to sell. You'll believe me because A, I'm a big owner, and B, my carried interest and my own incentive of working so hard is tied to an IRR hurdle. So I need to create the liquidity faster, but if it's not the right time, we're total returns investors. I think we're just lucky in terms of the timing that we can get both cash flow and upside, but the truth is, we're total returns investors. If I can turn more units and exit faster and get my 2x sooner, I'll do it.
I can see the lending partner, so I didn't understand from the beginning, but the capital that you raise is just from the investors, or you also have mortgages? And
we have mortgages. We do. This is a higher leverage play.
Okay.
Like today, the world of CMHC financing allows you to borrow, call it in the up to 95%. Today, the cost of borrowing would be about 3.6, fixed with about 40 to 50 years amortization. So unless somebody can find cheaper cost of capital than this, I'm taking as much of it as I can within reason. We typically raise the money for the business plan up front, so it goes down to about, call it low 80% loan to cost. But that's how you can think about it. So if you deploy about 20% of your equity, you need the property value to go up by 20% to double your equity.
yeah.
In the traditional private equity model, where you're capped by 65 or 70%, you need to, in order to double your money, you need to grow the property value by 30 to 40%. It typically takes just longer to get there. It's not impossible, it just takes longer to get there. That's what creates us the flexibility to exit much sooner, still making good returns on our capital. It's important to emphasize, because we've looked at a lot of markets in Canada. Edmonton is a good example of that. In Edmonton, I can go out and borrow 95% of every deal that I buy, because my yield is 5 and my cost of borrowing 3.5, so I got the spread to borrow. But the truth is, I don't know if tomorrow morning there's a building coming up next to me and my NOI goes down or stay flat, or the interest rate goes up by a bit and I need to write a check in 5 years. What I like about Montreal, and what we started looking in Ottawa very closely, when you buy at the bottom of your rent roll, basically when the leases are so low and there's only one way, the risk of borrowing higher is lower relative to the number perspective.
And that residual amount in Montreal and Quebec, how is this affecting the business in terms of increasing the rents? Because I know
It's a great question.
I lived there and remember people paying 50% cheaper rent compared to the market because they were in the property 10 years ago and they just getting in whatever is this rate.
It was one of my main concerns when I entered Montreal.
Mm-hmm.
And what I found is, going back to my point of like low expectations and mediocre results, being an owner in Toronto is far worse than being an owner in Montreal. In Toronto, there's such a thing, I don't know if it happens in Ottawa as well, but it's called rent strike. You know what it is? When the tenants decide together not to pay you the rent. And you have a mortgage to pay, right? And they have the right to do that. And by the time you can actually go through the process and get in front of the board in Toronto, it takes you about a year.
Yeah.
More. And they have unions, they're sophisticated, and they can hire lawyers. So you'll see, you can read in the news, Dream negotiated a settlement with a tenant. What does that mean? What does that mean? I give you, I provide you a service and you decide not to pay me because you don't like my price, you can also leave if you don't like my price. But in Montreal, there's a clear process. If somebody doesn't pay you, or doesn't maintain their unit properly, you can go away, and in 2 to 3 months, they're out. And the
That
challenge.
was my next question.
Yes. Yes, there's a very clear process. We didn't have a lot of problems with it, even with the process. We had a couple of processes happening, but it's very clear and seamless process. The other question, which is far more material, is how do you make sure when you renovate those units you can get those high rents? The practicality of it works like that. The theory is that the tenant can come in and look at the previous rent and challenge you.
Yeah.
And then go to the board and say, I want to pay the old rent. The practicality of it is that every time you get a lease, the first thing you check is if they've ever complained. So many tenants that went to the board for that today are having a really hard time to lease because every landlord said, not interested, thank you. So that it's the law of the jungle that basically works in a way that you can do whatever you want and you screen your tenants and you just take the good tenants. And there's enough of them out there that are doing it. We've never had one case, and we're about to approach 1,000 doors within last year that we're about to acquire. We've never had one case of that. I don't expect it. I think the other part of it, compared to Toronto, for example, and I don't know if Ottawa have reached that point, because it's very affordable, and because there is a lot of options of affordable options, nobody is very fussed about the fact that you renovated a unit. You can go into the same building, by the way, and lease an unrenovated unit for a couple $100 more, and you can go to the neighbor that is neglecting the property or not and paying the same. It's not such a hard thing to find an affordable apartment in Montreal. I feel that's part of the lack of resistance as well.
So from what you're saying, I understand the landlord in Quebec and in Montreal is fairly protected by the Régie company. And it's not like just the Régie working for the tenant, but still the pros.
The rules are clear.
Clear and equally.
Yes, they're clear. You got to pay your rent. You got to take care of the unit. If not, you're out. Like, I'd say the other very important point is that the Régie looks at the amount of money you invested in the property and allows you to hedge and basically increase the rent across the board, even for the non-renovated. Last year, there was a 6% increase across the board in Montreal. When we bought our first building, the landlords basically, so if you look, Montreal is the only market that has grown consistently year over year during 25. Every other market shrinked. The reason is, A, it's so affordable, as you can say, you can't fall from the floor. It's so cheap. That's it.
Is it the same in Montreal? The jour de déménagement, annual leases without the point, without.
Yeah, we're doing annual leases, correct.
Without breakout. I remember 3 months penalty was the clause.
Yeah, but the reality of it, like everybody's like negotiating around here. So like if somebody want to leave early and I want their unit, I'll go ahead. If I don't want their unit, they say, okay, look, maybe leave a month or two behind. It gives me the time to lease it back up. The truth is, if you look, it's the second lowest vacant market in the country. Vancouver is tighter, but it's basically now it gone up. It gone up to almost 3%, but it gone up across the board with a new product. The new product is probably in and around 10% vacancy today. The product that we're buying, once we stabilize it, is in and around the 2 to 1. Like we've had many months in the buildings that we've owned that we've had a fully leased building. It's just, it's so cheap that this is where the demand is going in tough times. And most of the clientele are immigrants or first time tenants in the country. So it's like, I've been on the other side. I know what it's like. We're giving them good service. We're answering the calls when they're calling us. We're cleaning up the hallways and we're painting the walls and we're putting intercom for them to be safe. The last portfolio that we bought from BMO, it's 400 plus doors. They didn't even know they had a bed bug problem, a severe bed bug problem. We spent $200,000 cleaning up all the bed bugs. The tenants were sending us chocolates. to the management office because nobody took care of them for like so long. Just the basic stuff. Take care of your customers. Give them good house to live in. They pay a lot of money for them. I remember I borrowed $2,000 from a charitable organization with no interest because it couldn't cover my $900 rent for the winter. And I had to paint houses and figure out my way. This is a lot of money for people. This is probably the highest bill they're paying. You got to give them good service.
Yeah.
We're doing that. We're doing the good thing, and I think we're compensating.
With the CMHC financing that you do, I'm guessing it's mostly the MLI Select, and we can testify for sure to the 95% financing because we've gotten that for our development.
Yes.
What kind of affordability do you put in your application?
So depending on the project, some project in the rent roll today has more than 40% of the rent roll below the affordability threshold. I'll go even more than that. You can increase the rents on the 40% by about $200 and you'll still not meet the threshold.
Wow.
So that's why Montreal is such an attractive market to operate in. Because I can get 50 points from MLI Select, which basically unlocks the 100 point. Because energy efficiency, everybody applies. So it gets the 100 point. 100 points basically means you can get 50 years amortization on your mortgage and up to 95% at the lowest spreads. And because you apply affordability, the lenders, they have buckets. The affordability bucket is the one that the government pushes the most. So my cost of financing goes down. So I borrow for less, I have higher leverage with better terms, and I can still increase my rent roll.
If the MLI Select actually disappears in 2 months, how does your structure look then?
So first of all, it's amazing. It's a great question. So at the essence of it, it's a positive spread. I'm not going to buy a building that I don't think I have a path to get to a 2 to 3% or 200 to 300 basis point spread for my cost of borrow. If MLI Select goes down, the only thing that it really means, don't forget, this market doesn't really driven by MLI Select. When you think about the biggest institutions in the country that own the vast majority of the properties, they can't touch MLI Select. It's only the privates that are playing the MLI Select. If I'm an institutional investor, I can't go above 60% loan to value. If I'm a public REIT, I probably can't go even above 55. If I'm an institutional private equity manager that invests, like Hazelview or anyone that you know that are playing and raising money from institutions, I can't go above that number. So it's really the private guys that are playing the game. The private guys that are playing the game in, call it in the 0 to 20 million. Above a $20 million property, it's harder to get MLI Select. It's harder to get the balance sheet to support the financing because they're looking at the balance sheet. Because we're structured like an institution, like a mutual fund trust, the balance sheet, the covenant that we have is so material that we can play in the bigger game. And if anything, our thesis is that we're buying from all these bigger institutions, anything from, call it 30 to 50 million and upwards, like the range for us is, call it in the $30 to $100 million per purchase, is because the privates cannot go as high and there is no institution on the other side buying. And we have a cheaper cost of capital from the institutions because we can borrow cheaper and they need to put basically like 35% of their cap stack at a cost of equity that costs them 18%. So if we borrow 80% of our cap stack with 3.5%, with 50 years amortization, we could be much more competitive, make more money, while still pay a little bit more than them in the deals.
I think I missed it too. What are your returns? Like, what are your returns expected?
We're targeting on every deal that we're doing. But like on the materials, you'll see like the official investment, I guess, debt. We would say 16 to 18%. Truth is, we don't touch anything that we don't foresee ourselves doubling our money in 5 years' time and generating 18% while stabilizing to 8 or 10% cash on cash.
Quick question on your structure with your operator.
Sure.
So when Kin Investment Fund goes into that joint venture limited partnership with that operator, the new limited partnership agreement that is setting up, is your operator a GP or just an LP?
Effectively, we're in control of everything. Effectively, we're the only real GP, but we're co-GP. Like, we're not gonna buy a property without saying, we're excited about this property, let's do it. We're not selling a property without saying, what do you think? Is that a good time to sell? We effectively operate together, but the truth is, from a pure legal standpoint, we have full control of it.
So your operator is still a co-GP, but
He's a
mainly
co-GP,
an
but he's a minority co-GP, right? So like, at the end of the day, when we come with the vast majority of the capital, we make the decision.
Makes sense.
Well, I've been to a lot of these seminars where other companies doing the same thing you guys are doing.
Okay.
And not one of them has said anything about Montreal, so what are they missing?
I think it's just a harder market to operate if you come from the outside. But because I came from the world of finding the local operating partners to actually do the job, it was very obvious to me that the guys from Toronto are not the guys to operate in Montreal. And the truth is, all the people that we're buying from, the biggest institutions to the smallest privates, can't even figure out the rent roll together. They give us a rent roll where you have tenants that are supposedly on the rent roll and their units is vacant for months, or units that were supposedly rented and there's nobody in the unit. Like that, because it's hard to, this is a very nickel and dimes business. Hard to manage that business when you sit in Toronto. But if you look at it, in Toronto, when the owners of those big companies are driving around and saying, what's going on with my parking lot here? What did somebody fix the lighting at the entrance for that property? When you drive around your property, it makes a big difference. And none of them has a local operating partner. They hire people from on the ground at best. In most cases, they just hire third-party property managers that is not related. And they're all the same, and they're not aligned with you. They're just here for the fees. That's the essence of it. So that's why, but if you bought 5 years ago, it doesn't really matter. If you bought 10 years ago, it doesn't really matter. That's it. Any more questions? Good?
Good, yeah.
Let's go.
Fantastic. Thank you.
Okay.
Thank you. Awesome. Okay. Well, this is a real treat having the CEO here. And, very, very high level. So
Thank you, Jacob.
Thank you very much, Jacob.
A top-down approach.
That's good.
All right. Did he get to his really expensive slide?
Nope.
Let's get that.
I don't think there was a legal disclaimer. There's no legal disclaimer on this one.
If they want, they can
Absolutely.
find everything through you.
Absolutely.
Thank you.
Absolutely. Excellent. All right.
There we go.
Well, folks, that concludes the evening. But if you have any questions, feel free to get in touch with Robert, myself, or Ruth.